Welcome to the Clear to Close podcast with your host, local mortgage expert Ryan Bolton. Ryan has the questions and answers, tips and tricks, do's and don'ts, and expert guests to explain all the steps needed to buy or sell real estate. And now it's time for the Clear to Close podcast.
Hey everyone, Ryan here. I am a mortgage nerd. Welcome to the Clear to Close podcast, where we talk about all things real estate, mortgage, credit, all those fun things. And we call it Clear to Close because that's one of the terms that we're all looking for as we get a contract in the office, we get all the underwriting done. We want to get you cleared to close. So Clear to Close is kind of the fun name here on the podcast. I think this has been like 50 episodes of this show so far, so I've really enjoyed doing it. It's just fun to stretch myself. And so today, I thought it would be fun. We got our producer here. I call him Freddie Mac, kind of a play on the idea. If you know the mortgage world at all, you know who Freddie Mac is, and he's my producer. Say hi, Freddie.
Hi.
Oh, he's found some questions for us off of the internet to see if we can stump me and just kind of go through them. And sometimes you don't know the whole context of the question, but it's just fun. It just kind of keeps you on your toes. And we'll just
you wanted mortgage questions, right?
Sure. I mean, whatever.
Hold on. I better close this tab. Hold on.
We're gonna switch tabs.
Now are we ready to roll?
Yeah. Let's just see what you found on the internet. The wonderful, perfect, calm, wonderful world of the internet. All the comment world of the internet.
How can you buy real estate mortgage notes?
Oh, okay. So just like servicers, the note is a commodity in a lot of ways, and some notes are sellable. So if you have something where you want to purchase that note, it really has to go to the note holder. So whoever has the mortgage would sell that note off or transfer the servicing. More common, you'll see where they're transferring the servicing. You've probably seen it happen with your own loan, that you did the loan with a mortgage company, and before you even made the first payment, somebody else already bought the loan. A lot of times they get securitized, they get put into these big bonds and get sold on the secondary market. But you also see local credit unions and banks, they'll have auctions, they'll have things to sell off their notes. More common, you'll see it when it's a distressed note or something that maybe they don't want to go through the whole foreclosure process and just want to sell the note that's distressed. But other times you'll have lenders that just don't want to service loans anymore, or they need to free up capital and they will sell the note. So the short answer is yes. You can go to most local banks, most local lenders, and see if they're doing any kind of note sale or if they have any specific notes they're looking to clear off their books. But the short answer is yes, you can buy notes just like you would any other security. Usually they'll come up with the dollar amount that they want to get off of it, depending on if it is late or distressed or something like that, or depending on the location. So there's a lot that goes into it. But the short answer, yes, you can buy the notes off of mortgage companies all the time. Happens all the time.
Okay, next question.
Great question.
What is a zero-interest real estate mortgage?
That is a fantasy. That is a fairy tale that is not in existence. Why would somebody give somebody $200,000 for 30 years to pay it back and not collect any interest on that money? They'll lose money just to inflation. So the interest rate, part of interest rate is to make up the money to loan the money today and then get that money back over years and years of servicing that loan. So a zero interest mortgage loan, I mean, I haven't even seen like an introductory or an adjustable rate mortgage at 0%. So they happen in car loans. You'll see that sometimes where they don't charge any interest rate because they just build it into the sales price. But I don't think I've ever seen a mortgage rate that's been zero, for any length of time. Like, zero interest for the first 6 months. That doesn't work with mortgages. It's just a different animal, usually a lot larger loan amount. I mean, the loan amounts on mortgages are way bigger than cars and other types of loans. So that, my friend, is a fantasy. You're being sold a bill of goods. Don't send your credit card. Don't give your social. He's from Nigeria. Don't do it.
Yikes. Wow. All righty, next question here.
All right.
Is a real estate mortgage a real contract? Why or why not?
Of course. So it is. That's an interesting. Okay, real contract. So it's a note, it's an obligation, and it's collateral. So contract is more the agreed upon price. When I hear contract in my sense, it's okay. I agree to pay X amount for your house. Here's the conditions of that contract. Where a mortgage is more of a note. It's a security against that asset, and you have to make payments, and there's certain obligations. So there's still obligations and things that happen if you don't make your payment, which is kind of contractual in a sense. But I wouldn't call a mortgage a contract. I'd call it a note, a security, those types of things. So it might just be getting stuck in the word usage here. But I wouldn't necessarily call a mortgage a contract. I would, in my world, a contract, when I hear contract, I think the real estate purchase contract, the terms between a buyer and a seller. Like what's included in the house, what's the price, what's the Who's paying what? Is the contract subject to an appraisal or a home inspection? That's more when I hear contract. When you're signing on a mortgage, you're not signing a contract per se. I mean, it is a form of that, I guess, but really it's a note. The loan you're signing is a note. In Utah, you're signing a deed of trust that allows the lien against the property. And that's where we don't own the home as the mortgage company. It's just simply the collateral that you're putting up to back up the loan. So we don't own the house. I hear that happen all the time where people say, well, I don't own the house, the mortgage company does. I never had Freddie Mac show up at my house because they have my loan and say, hey, we want to use your house this weekend. We own it. No. Oh, you owe the property taxes because it's your home, but the mortgage company owns it. So I know it's semantics a little bit of what we're talking about here, but I wouldn't call it a contract. There's still contractual things, like you have to do certain things. If you don't, we take back your home. But the more proper term for me would be a note and then the deed of trust against the property. All right. What else you got?
Let's see. I just changed it really quickly. What are the downsides of doing a reverse home mortgage?
Okay. So reverse mortgage is for the elderly. You have to be a certain age to even qualify for the loan. They've recently changed it where you only need one person to be over 62. So we had the situation a few years back where somebody turned 62, but the wife was 60 or 50, younger. She couldn't be on the loan. Then all of a sudden something would happen with the husband, the father, and all of a sudden there was big issues on who actually owned the property. So they have changed the requirements that only one needs to be of the age. And as you get older, they give you a higher loan to value. With reverse mortgages, you don't make a payment. Your equity makes the payment. So your balance goes up. That's one of the downsides, if you will, with a reverse mortgage. Now, with reverse mortgages, they don't loan 100% of what the home's worth. I think the most they've ever loaned is like 60% of what the home is worth. And a lot of that comes down to how old the person is. So the older you are, obviously life expectancy goes down as you get older. So they loan more the older that you are, and depending on the interest rate. As interest rates go up, the balance is going up faster, so they loan less. So they're very safe loans for lenders and for people because they usually don't loan more than 30 to 40% of what the home's actually worth. So the downside most people don't realize is it's still accruing interest. The balance is going up, but usually the rates and the appreciation factors don't want it to go upside down really quickly. Now, if it does, there's still mortgage insurance that kicks in. So if you happen to get in a situation where the values in your area just tank and all of a sudden you're upside down on your reverse mortgage, they don't come after your kids or your estate or whatever you've set up. They have insurance that kicks in. But I don't think in the last 20 years there's been a claim on reverse mortgage insurance. I mean, it's just something where they're so safe in the guidelines that they do. I'm sure it has happened, but in most areas you're not going to see these loans go upside down. But the disadvantage most people don't realize is the rate is higher, the fees are higher, and the balance is going up. But for the right person, it's one of the best loans out there. If you've got somebody that's retired, they're living paycheck to paycheck, Social Security, the Social Security check, they have insurance, bills, they've got all this stuff, and they cannot make a mortgage payment but want to stay in the home they're living in, reverse mortgage is really a good loan. I think when it first came out, it had a lot of problems. It still has some stigma with some of the older generation, but it's a much, much safer loan. And I've told you, some of my better success stories have been some of the reverse mortgages I've done because they really are the good loan for the right client. Just like any loan has benefits and disadvantages, but a reverse, I think, has more benefits than disadvantages. But the biggest one is the interest rate, the fees to get it, and the balance goes up. Those are probably the two biggest disadvantages.
Okay, this one's got some drama behind it.
Oh, good.
We live with my in-laws. They pay the mortgage, and my husband and I pay all other taxes and bills. My mother-in-law just told me that she wants us to pay half the mortgage as well, but will not add our names to the house. How do I politely say no?
Interesting. Okay, so
I think that you just say no. That's the easy part of the question, but
yeah, I would say it's tricky because if you don't make your payment, you don't have the consequence of having to make the full payment, all the appreciation or equity at that particular point. Also, you can't be added to the loan unless you refinance to put it in your name. You can be added to the title report, so you can be added as an owner of the property. But that's a tricky one, especially when you're getting family involved, that kind of stuff. It's up to the family situation there, but I would say, okay, if you were to buy into the investment, if you were putting a down payment to begin with, if there's some sort of contract where you can say, okay, we'll pay half the mortgage, but we want to see half of some of the benefit for that. There's there's a way to do that without actually having to be on the loan itself. There's a way to do that without actually having to be on title if you make the contract, and just treat it as a business deal. Just as soon as family gets involved, it gets really awkward sometimes, and it can blow up families when you kind of try to do some of these things. But really, there's no reason they would have to do that. But at the same time, if they don't get your help to do it, and there's got to be some benefit for you as well. I mean, you think if you're paying half the mortgage, there ought to be at least maybe some consideration. Okay, from this point on, I get to share in some of the equity or the tax benefits and some of the stuff of owning the house, and while keeping everybody in that house, because it's probably cheaper staying there with family than it is probably going off on your own. But that's an interesting one. But I mean,
technically, she's just a renter.
Yeah, it really is. She
So
really is a
she can just stay the renter and adjust whatever her monthly payment is, or, as you said, refi and put everybody on the loan.
Yep. That's probably the safer thing. The more it can be just cut and dry, treated as a business, written down, no handshakes or, hey, you said this, I said this. And you just want to get it all in writing, get everybody on the same page, and just move forward that way. So there's still going to be hard feelings, but you'll really minimize it if you just get it all in writing and just make sure you understand what's happening. Absolutely.
All right, next question. I've had to ask this question more than a couple times. How can I get a mortgage with bad credit?
I tell you what.
Dun, dun, dun.
Every single time I log on to Quora, any kind of answer website, that does, or Reddit, and all that kind of stuff, this is the most common question I see all the time. And the answer is somebody's going to loan you money. You could have a 400 credit score, and somebody's going to loan you money. The rates and terms are going to suck. You know what I mean? I mean, I always work with clients and say, okay, first of all, why is the credit bad? What are we dealing with? What is bad credit? Somebody's bad credit is not the same as other people. I've seen, I have really bad credit, I'm a 680. I've had other people, I've got okay credit, it's a 510. So there's a lot of things you can do to work on your credit first. I really think it's not that hard to get in the 600s. It's not that hard to get into the 640 range if you know why your scores are the way they are. So yes, you can get a loan with bad credit. We have loans that go clear down to like 580 credit score, which is pretty bad. I mean, in Utah and Nevada, the average is around 680. So if you're under a 680 score, think about the average Utah and the average Nevada, and they're at 680. So if you're under that, you're kind of under that threshold, and it's not hard to get into the mid sixes, depending on why it is. Now, I've seen people that just kind of bury their head in the sand. They did stupid things as they were a kid. They got credit cards. They turned in cell phones. They have all kinds of lates and charge-offs and all that kind of stuff. And they just kind of forget about it till it's finally time to get a car or a home loan or something like that. And so sometimes you got to go back and revisit some bad decisions and just start settling with people and just start building some positive. And it'll take some time, but that's the effort we need to do. Instead of say, hey, just give me any loan you can get me. Well, okay, here's 14% and 5 points. Ugh. You wouldn't want that loan very long, or they're going to require a ton more money down to offset the risk of that credit score. Versus saying, okay, instead, let's spend 2 or 3 months. Let's spend 6 months. Let's put together a plan to get your score to the minimum. You can get 100% financing with a 620 credit score. It's not like you need a 900 credit score to get a home loan. But if you can get to 640, 660, they're always on these 20-point tiers. So many more things start opening up. Better interest rates, less money down, more buying power because you're not paying such a high interest rate. So it's important to get started. Credit can take some time to get it cleared up. But if you know why it is the way it is, you can start working on the what to get it fixed. So yes, the short answer is you can get a mortgage with bad credit, but why not work on the credit first is what I always tell people.
All right, our next question. What is the difference between a home loan, a mortgage loan, and a loan against property?
Nothing. These are all just terms of loans. So a mortgage is a loan against a property. A home loan is a simpler version of the word mortgage. I'm blown away. This is something that always surprised me in my career, where people say, well, I don't want a mortgage, I just need a home loan. Because it's something intimidating or scary about mortgage or something. It's like, oh, that sounds more fancy or more underwriting guidelines or harder to get because it's a mortgage versus a home loan. Really, these are all the same terms. I remember one guy, I was in college or something doing like a criminology class or something because I thought I was going to go into law enforcement when I was in high school. And the guy, I remember the cop came in and said, hey, what's the difference between murder and killing someone? Nothing. It's the same word. It's just more technical. Murder is more technical than killing someone. You know, how with manslaughter and the different levels of the penalties that come with killing someone. But it always kind of stuck with me that there's just words that mean kind of the same thing. They just can be either more sophisticated or something about it. But I have had so many people, I've blown away how many people say, I don't want a mortgage, I just want a home loan. I just need a loan to buy this piece of property. So I stopped using the word mortgage with that person because I don't want to scare them. I don't want them to go, oh, no, mortgage. I'm not signing a mortgage. I just need a loan. But it's the same thing. All those three things are they're the same thing. They're a loan against real estate.
All right, this is a good one.
Oh, hey.
How are mortgage interest rates calculated?
Okay. So
why is it 3%, 4%, 5%, or we were down in those twos a couple years ago?
Right.
What were we at, the 17s 30, 40 years ago?
Yep.
Why?
Right. So there's a lot of factors that go into interest rates. The big thing is the cost of money, the cost of inflation. Those things factor into it, and really how much money is going into bond markets to determine those capital interest rates. It's a supply and demand thing, just kind of like oil. Why do oil prices change and go up? Because the cost to get it delivered. These are all, they still factor into mortgages. And so as a lender, they're looking, okay, the cost of money is what it is. Profit centers have to be what it is. The risk of having that money out that long has to be built into risk, like insurances. There's a lot of things that kind of factor in to what determines the rate you're actually going to get. And there isn't just one rate. There isn't something where, okay, today's rate is 5% for everybody. Well, the base rate may be 5% on one day, but then as you look at that specific loan, whether the term, like a 30 or a 15 year is going to be a different rate, the credit scores are going to determine different rates, the type of use of property is going to be a different rate. So if it's a townhome or a condo or a single family, if it's a primary residence, a second home, all these things go into kind of this risk assessment and comes up with, okay, this is the interest rate at that particular time. But there is like base rates, prime, market, capital markets will determine kind of where rates start. And they usually will always just kind of go up from that based on the risk of a specific file. But that's where there isn't just one rate. And there isn't just the lowest rate, because the rates are going to be different based on how you're using the money, how long the money is going to be out, how much money they have to make to do that. Points and fees factor in. There's just a lot of things that factor. That's why every rate can be different. So as you sit with me, we go through and say, okay, what's the scenario? What's the best rate for that scenario? You also have lenders that don't do certain loans. So to do them, they offer a higher rate. So, well, we really like these loans. We will do this other one, but we got to make a little more money for the risk or whatever it is. So they charge a higher rate for that particular loan. Where other investors say, no, we like these loans. We'll offer better rates for these clients with that type of scenario. And that's part of my job, is saying, okay, which lender likes the loan scenario we're trying to propose? But that's why rates are different. Every rate, and they change every day. Just like stocks and prices, they'll change every day.
All right, and you've used this term a couple times, even in the last 2 minutes.
Ooh.
What are mortgage points?
Now,
points. I understand the percentage, but even I'm like, you mentioned points. I'm like, what, like touchdown or?
Yes. Soccer. So if you like soccer, you pay more for a mortgage than if you like basketball. I don't make the rules. I don't make the rules. Just certain sports, you're going to pay more money for if you like. All right. So points are a percentage of the loan amount. So 1 point is 1% of the loan amount, not the sales price. It's of the loan amount. That money is like prepaying to buy down the interest rate. So if you use a point to buy down your rate, you're essentially prepaying the interest today to get access to that cheaper money for the life of the loan. And why it makes sense to pay points will depend on how long you keep in the loan. If you're going to keep it a long time, over the course of the loan, that lower interest rate will make up for it. If you're going to keep it shorter, paying that extra money up front doesn't help. Now, points can also be used to offset the risk. They're called hits to the rate. So you'll have, say it's a non-owner occupied. There'll be a hit that you can either pay for or build into points or build into rate. So this is the rate to fee combination every loan's going to have access to. And I see sometimes where, let's say it's a 6.5 rate and getting a 6.25 rate, so lowering it 0.25%, doesn't cost very much. But then if you go down 1 more eighth, it's a huge jump. Every rate kind of has a different fee associated with it based on how that money is getting bought on the secondary market, what the bond curves are, a lot of technical terms on what determines each individual rate. But you can use this points or money to change the interest rate that you're going to get on the loan. It works in the reverse as well. So instead of paying a point, you could not pay a point and raise the rate to offset it. So you could use it to lower the fees or raise the fees to get the right rate to fee combination that you want. So points is another term of just prepaying money on the mortgage to change the interest rate that you're getting offered.
Perfectly clear. Actually, no, that did make some good sense. All right, I got another drama one for you. I just found out that my landlord filed Chapter 7 bankruptcy.
Oh, okay.
Is it unethical or immoral of me not to pay my rent anymore since he is not paying the mortgage?
Interesting. So, yes. I mean, you signed a contract regardless of what the owner does with it. So ethically speaking, morally speaking, you probably still owe that particular debt. But at the same time, I don't blame you for not wanting to make the payment with it. I will tell you this, a lot of times the trustee, the bankruptcy court will take over that property. They'll honor your lease agreement if you're current on it, where if you stop making payments on it, you're also in violation of that lease. When a new owner takes over, they can tell you to get out. They can evict you. So it's sticky. I mean, I've seen a lot of times where I've even seen where lenders will offer the renters cash for the keys and say, okay, we've got a new buyer coming in. The buyer wants to be in the home, or we're doing something with the property, whatever. Here's $2,000 to move out. Go find another property. So that it's a program called Cash for Keys on some of these situations. But just keep in mind, if you miss that payment, it can report negatively to credit, depending on how he's reporting that and depending on the property manager. Doesn't sound like there would be a property manager in this case, but there could be. You still have an agreement with that property. He's violated his, so he's losing his collateral. But if a new owner shows up, the bank, a new investor buys that note, takes it over, and then shows you haven't been making the payment, they can evict you from the property. So it is something where you want to probably make out some arrangement or get the money going directly to the trustee at the courts instead of to the person that's not making the payment anymore. I've seen some people do that where they'll get a hold of the trustee and say, okay, I still want to make my rent payment. I don't want to get kicked out. I want to honor my lease, but I obviously given the money to him that's not going anywhere. I look at it doesn't matter where he's doing with his money. It's something where you're still owe for that rent. And it can come back to bite you. It really can if you just stop making that payment.
Okay. What are mortgage-backed securities?
Mortgage-backed securities. So this is where the bond market with mortgage-backed securities pools a bunch of mortgages together and sells them as a security. The mortgage-backed securities, or MBS, is what determines interest rates in a lot of ways. The demand for those big blocks of mortgages determines interest rates and determines the future rates of what those securities are going to go for. So it's really a fancy name for the bond market that really determines mortgage interest rates and what you can buy as an investor to buy this bond. The treasury bonds are usually less. So you have the federal government bonds. Mortgage-backed securities usually offer a higher interest rate, but also have a lot of good security tied to them because it's a pool of like 100 mortgage loans that are making their payments on time. So it's another security. It's using mortgages, the loans on mortgages, as the investment, as the vehicle of that return. But they're not as good as maybe stocks and bonds, but they're not as volatile. So they're kind of a better returning rate on a bond. And the bond is backed by mortgages, mortgage payments being made. So that's a good one. That's one of the things that factors in interest rates.
Okay, so out of the, this is from the robbing Peter to pay Paul category.
Okay.
Is it possible to pay my mortgage with my credit card?
Yes. Mortgage companies are going to take your payment. They, is it a great idea? Probably not. Now, I have seen people, they'll use a credit card or something like that to get the points and then make pay down that credit card. So it depends on if he keeps a balance on the credit card, because the rate on the credit card is going to be worse than the mortgage. So that's kind of silly. But short answer, yeah, they're going to take your payment on whichever way you can make your payment. And it's better to put it on the credit card than being late on the mortgage. So, but at the same time, I've seen people use those techniques where they'll use a credit card to kind of get miles and points and all that kind of stuff, kind of free money, but then they don't pay the credit card back off. And all of a sudden now they're carrying a balance on their loan at a certain rate. Now they got this credit card that's almost always a higher interest rate. But the short answer is yes, you can use credit money to make a payment. They're going to take your payment. If you owe the money, they're going to take it.
All right, our next one here.
We got how much time left?
We're almost a minute and a half here.
Okay, all right.
What are some strategies to reduce mortgage payments?
Reduce mortgage payments. Now, you can reduce your balance, but as far as reduce mortgage payments, you're only looking at a refinance, which is lowering the interest rate, removing mortgage insurance, those types of things. So accelerating your mortgage by paying extra pays down the principal, but really doesn't change the payment. You still owe the payment. The note is a 30-year fixed. In most cases, it's a 30-year fixed mortgage. If you make the minimum payments, then you'll pay it off in that time frame.
I can't make 10 payments, a little bit more, and then skip the last 2 months of the year.
Right. Now, some lenders will allow you to do that. There is some lenders that say, okay, I don't want this to go to principal and interest. I want this to accelerate my next payment due. But it's very case by case. The way mortgages work, anything above principal and interest goes right to principal, which then over the course of the entire loan, you'll have less interest. You'll pay off the loan faster. But let's say you have a $2,000 a month mortgage payment and you pay $4,000. It's not like you've made 2 payments. That extra $2,000 goes right to principal. And then you still owe another $2,000, but now your payment's accelerating, going more to principal, so you're cutting term off the loan. But it doesn't make the next month's payment. Anyway, hope you enjoyed the show. Check out my website at ryanbolton.com. If you have any questions, please submit them. I'd love to see you. We'll talk to you on the next podcast.
This has been the Clear to Close podcast. Please submit your comments, questions, and topics for future episodes to cleartoclosepod@gmail.com. That's clear the number 2, closepod@gmail.com or ryanbolton.com. Please like, follow, and share. And until next time, this is the Clear to Close podcast. The views expressed in this podcast do not necessarily reflect those of Patriot Home Mortgage, Equal Housing Lender, NMLS number 299717. This has been a production from a podcast studio.